Equities have been falling quite a bit recently, and a lot of it has to do with the fact that it's not only an election year, but it's also September. And September is historically known to be a very high volatility month where stocks tend to fall. Only 3 of the last 10 Septembers have returned positive, with an average return of about a -3%. With that being said, I wanted to talk about some of the best ETFs that are not only extremely solid, but can actually protect you from major drawdowns when the stock market experiences volatility. So in this video, we're going to go over 4 different ETFs that I believe are great for really any portfolio or strategy and can not only help you build significant wealth over the long term, but can also protect you from major drawdowns. XLG is the Invesco S&P 500 Top 50 ETF that tracks and replicates the S&P 500 Top 50 Index, which is pretty self-explanatory. It consists of 50 of the largest companies in the S&P 500 on a market cap weighted basis. In its portfolio, you'll find Apple, Microsoft, Nvidia, Amazon, Meta, Google, Berkshire Hathaway, with Eli Lilly and Broadcom at around 3%. And although this ETF might be considered slightly on the risky side since it is pretty heavily weighted towards the tech sector, its risk-adjusted returns might just make up for it. In the short term, it has a year-to-date return of 19.5%, which is still over 3% higher than that of the S&P 500. So it's a great ETF if you're wanting something that's a little bit more concentrated and consists of some of those faster growing mega cap companies in the S&P 500. I'd say it has a very average expense ratio of 0.20%, which still isn't quite as low as some of the other low-cost index funds. But even at 0.2%, that's still very minimal in terms of fees. It also pays a small dividend of 0.81%, which actually isn't too bad for a growth-focused fund. So although XLG might be considered just a little bit on the risky side, I do still think it's a very high-quality ETF. Which brings me to the next one, which is GLD, or the SPDR Gold Shares ETF. Now I know that gold is an asset class that you might typically find in a boomer portfolio, and I get it, it's a very boring asset to follow in terms of its price movement, but it's a great safeguard and protection from volatility, especially in rockier times. It has an extremely low beta of 0.11, meaning there's almost no correlation between the returns of the S&P 500 and the price of gold. And again, although the price of gold can kind of be boring and slow, over the long term it stays incredibly consistent. For example, since about 2017, it's up over 100%, and even during the 2008 recession, it gained over 70% during that time. And its worst year over the past decade was only a negative 10.6%, as opposed to the S&P 500's worst year of negative 18.17%. So if you want exposure to gold without having to go buy physical coins or gold bars, GLD is the perfect ETF to have in your portfolio for that exposure. The next one is IAK, or the iShares US Insurance ETF. This is one of my favorite ETFs because large cap insurance companies tend to be very powerful as well as very profitable. In this portfolio, you'll see some of the largest insurance companies on the market like Progressive, Chubb, Allstate, and Aflac, with a total of 56 holdings. It does also pay a small dividend of 1.24%, and although it's on the lower side, it does keep its dividend fairly consistent year over year. It also has a very average expense ratio at 0.39%, which again sounds like it might be slightly higher than other low-cost index funds, but in the grand scheme of things, you're only paying about $40 a year for every $10,000 you invest. There's also IYF, which is another sector ETF, also issued by iShares. It's very similar to IAK with the same expense ratio at 0.39% and about the same dividend at 1.4%. Now, although you'll see some of the same companies like Chubb and Progressive in its top 10, you'll still find Berkshire Hathaway at 13.5%, with a lot more holdings at 142. Both IAK and IYF have had really steady returns over the past 1 year, and with this recent market sell-off, it might be a good time to start buying into both of them. There's also no overlap between the two funds, it's only at about 16%, so there's definitely nothing wrong with having both IAK and IYF in your portfolio. So I think a good blend of these 4 ETFs would be great for really any type of portfolio, but make sure to let me know what you guys think, and I'll see you next time.